Hello and welcome to this Tolley Seminars Online lecture where I'll be looking at the changes the Chancellor announced to those saving for their retirement in Budget 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley. Now the Chancellor has announced some changes to the pension regime applicable from April 2014, so giving us a year to get used to these changes, and they are changes that we really do need to start planning for. Firstly, the annual allowance, the maximum amount that we can pay into our pension scheme in tax year 2014-15 and beyond will reduce from the current £50,000 to just £40,000. Now that will mean that individuals who are currently contributing higher than £40,000 will need to cut back what they pay in or face a tax charge on the excess over £40,000 liable at their marginal rate of tax of perhaps 40 or even 45%. In addition, the Chancellor is also reducing the maximum amount that we can have saved in our pension. The current limit is 1.5 million. Now it was due to be 1.8 million time, but that was cut back a couple of years ago. So an individual will be able to have a maximum of £1.25 million saved into their pension fund from April 2014. Now, what does this actually mean? Well, if, for example, you have more than 1.25 million in your pension fund, at the point you start withdrawing money from your pension, the fund will need to be valued, and any excess over the limit will be liable to tax. It's liable to tax at best part of 50% if you are taking that money by way of a lump sum, certainly not a tax-free lump sum, it's a heavily taxed lump sum, or at a lower rate if you decide to draw that additional amount down by ongoing pension. So therefore the charge only kicks in when you start withdrawing from the fund. If you have a partial withdrawal, for example you retire and you only decide to take 60% of your pension, then 60% of the excess above 1.25 million will be liable to those appropriate charges. Now, there is an incentive, therefore, for 2012-13 and 2013-14 for individuals to make larger contributions into their pension fund. The reason being, of course, that you're currently paying £50,000 and you can also bring forward unused relief from the previous 3 years. So, for example, if you only paid in £40,000 in the previous 3 years, you've obviously got £10,000 per annum to bring forward into 2012-13 and 2013-14 to make a top-up pension fund contribution. Now, this can be a particular problem for those in final salary pension schemes, which I'll be looking at shortly. Now, what happens then if you're acting for a client where they thought legitimately they could save at least 1.5 million to their pension? Now they're told it's going to be cut from April 14 to just 1.25 million. Well, you can claim what's known as fixed protection. And fixed protection 2014 basically means that you are allowed to treat the level of the fund valued at the 5th of April 2014 as though it is a lifetime limit. The downside, of course, is that you can no longer contribute to that fund, and therefore you actually freeze that fund, but you do not have the additional tax charge where the fund is obviously valued when you start to withdraw it at more than 1.25 million. Because let's say it's worth 1.4 million, you can freeze it at 1.4, you don't have a tax charge when you come to withdraw from that fund. Now, it's worth those of you who are looking at Fixed Protection 2014 to follow the consultation that's currently taking place over auto-enrolment. Currently, the Department for Work and Pensions is proposing that Fixed Protection 2014 is excluded from the auto-enrolment system, but there may be a change of heart whereby it will actually be included in the future. So keep your eyes pinned to what's happening with that particular consultation. We at Tolley have a separate business unit, Payroll Alliance, which is looking at auto-enrolment, so it's worth you taking a look at our website there, which will be keeping up to date on auto-enrolment at www.payrollalliance.com. Now, the pension input amount on which we work out whether we have a tax charge is very easy where you're looking at individuals who save under a money purchase arrangement, because simply if you're contributing more than gross equivalent in a year of £40,000, then you have a tax charge. But what happens if you're under a defined benefit or final salary pension scheme? Well, the rules are a little bit more complicated in the fact that your deemed contribution is dependent on the increase in your member benefits over the tax year. So let's take an example here. Let's take an example of an individual called Chris. That's a nice strong name. And Chris is a teacher in a pension arrangement giving him 1/80th of final pay as a salary for every year that he serves in the scheme, with a lump sum of 3/80th of his pensionable pay for each year of service. And the rules of the scheme are that your pensionable pay is the pay that you received over the previous 12 months. So at the start of tax year 2013-14, for example, Chris has 24 years of service, his pay is £45,000, and during the year he is promoted from head of department, say, to deputy head in the school. His earnings now go up to £55,000, so his pensionable pay for the 12 months ending April 14, for example, will be £51,600. So turning now to the opening value of his pension fund. Well, the opening value will be 24 years worth of service, so 24/80ths, on an annualised salary of £45,000, which is £13,500 worth of pension, and we assume for these purposes, because this is built into legislation, that he will survive 16 years post-retirement. That's obviously something that he may or may not do, but that's the way that the calculations are required to be done. So that gives him a flat factor of £216,000. We then add in the lump sum, which is 3/80th of 45,000, giving him an overall opening value of 256,500 at the beginning of the tax year, but we then have to upgrade that based on the rise in the CPI to take him to a revised opening value or restated opening value. Let's say that that is 3.1% in CPI. The opening value then is then upgraded to £264,452. We then look at the closing value. Now, Chris has been subject to a pay rise this year, so his pension now is 25/80ths of his annualised pay for that tax year, which has now risen to £51,600, which is then 16,125. We then apply the flat factor of 16, giving us 258,000. We then take account of the lump sum, which is now 25 years at 3/80ths of the higher salary of 51,600, which is 48,375, giving us a closing value at the 5th of April 2014 of 306,375. So the pension input amount is the difference between the closing value and the opening value, which is 41,923. Under the current rules, where he's allowed £50,000, there's no tax charge. But from April 2014, assuming that he has that rise, say, in 2014 to the end of April 2015, then he'll have a tax charge of £19,023 at 40%. And he'll have to show that on his self-assessment tax return. He'll probably have no idea that the tax charge is due, let alone any clue on how to calculate it. But if we are acting for people in these situations, these are the things we need to now be looking out for on their tax returns. For £50,000, you might find you're actually okay. At £40,000, you might find that even a modest increase in pay can bring about a tax charge. Turning now to some other pension changes, the drawdown cap is going to increase from 100% to 120% to apply to pension years commencing on or after the 26th of March this year. Now, what is the percentage of? Essentially, it is of the equivalent pension that would be available through a purchased annuity. Now, the reason that the Chancellor introduced a cap in the first place is that under the drawdown rules, instead of investing your pension pot into an annuity which pays your pension for the rest of your life, however long or short that happens to be, you'll always get that pension. You do have the choice to draw down your fund and not buy an annuity. But in order to protect the fund, and indeed protect the government from the fact you might run out of money one day, and therefore be reliant on the state, they say the maximum you can draw down was previously 100% of the basis amount, which is i.e. the equivalent of the purchased annuity. They're now allowing that to be increased to 120%. It is also worth at this stage pointing out that if you have a separate pension fund, that say ring-fenced, say provided by, when you are self-employed, and then you have a main fund which is providing you with a guaranteed lifetime pension of at least £20,000, your drawdown is not capped at 120%, it's not capped at all, provided you do have a minimum pension coming in of 20,000. So for example, you might have a final salary pension scheme which is paying you a pension, say, of £21,000, and then you've got a separate fund, say, with about 80 grand in it. You can draw down the full 80,000 and go around the world if you choose to do so. However, you do pay tax as income, of course, on that £80,000. Pension payments to a scheme registered to an employee's spouse or family will now be subject to income tax and national insurance on both the employer and employee from April 2013, where, of course, it's paid to the spouse who is not working within the business. So, therefore, treated essentially as a benefit in kind. So just be careful with those rules, particularly for owner-managed companies, where the spouse perhaps does not have a justifiable role within the company. There will be draconian tax charges applying where the company or the individual is saving into such a pension fund. Well, many thanks for listening to this lecture on the pension tax changes that have taken place in Budget 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley.